Well, let's talk more about the bond market reaction here, because that is something that Brian Cheung wrote about. And he is with us now. You see there the 10-year yield and what we've been talking about, that even with these hotter inflation readings, the 10-year yield has remained pretty subdued and, in fact, has come down a little bit in recent days. So, Brian, as you look at this, what do you make of sort of the explanations that Myles was just talking about? And I know also we've had some foreign buying of treasuries, which is something that could be keeping the yield low as well.
Yeah, well, good morning, y'all. We need to talk about the inflation numbers first, though. When we talk about the bond market reaction to yesterday, it is indeed exactly as Myles laid it out, which is that the bond market was not pricing in any sort of inflationary risk that would cause the Federal Reserve to raise its rates any faster than the market was already expecting. So if you unpack the CPI figures again that came out from the Bureau of Labor Statistics yesterday, for the month of May, we saw that CPI, the Consumer Price Index, increased by 0.6% on a year-over-year basis. That was 5%. And a reminder that that's the hottest year-over-year print that we've seen on a monthly basis since August of 2008. And even when you strip out those more volatile components like food and energy, you still got 3.8% on core CPI. That was beating the street's estimates of 3.5%. And that, by the way, was also the highest that I've ever seen in my lifetime. You'd have to rewind to early 1993 to get a print that high. So the inflation itself is undoubtedly high. The question is, of course, how did bond markets react? And you take a look at the 10-year, for example. Yes, after that print first came out, we did see the 10-year rise up to something like 152 basis points. But actually, over the course of yesterday, as markets continue to digest that data, as you mentioned, Julie, the bond yields continue to fall. So we actually are now seeing about a 146 handle in basis points on the 10-year. So in summary, nothing had really changed in the way that bond markets are thinking about this. And for a little bit of a mini Yahoo U, it's a reminder that the 10-year bond yield tends to be a proxy for longer-term interest rates. So you know that right now, the Federal Reserve has short-term interest rates somewhere between 0 and 25 basis points. So at almost 150 basis points on the 10-year, that implies that markets are saying, we don't expect the Fed to raise interest rates more than 5 times, or at least 5 25 basis point hikes over the next 10 years. Of course, a lot of that could change. Expectations is for bond yields to go up. But you look at the arguments going on right now, when you look at Chris Rupke, for example, saying inflation isn't normal, it's way past that now, quote, sell bonds. But then you have other people saying this is the bond market reaction that's digesting the Federal Reserve's full reaction function. So it seems like full steam ahead, team transitory. So that war very much happening in the bond market, guys.
Yeah, all right. I mean, we get it, Brian. You weren't born in 1992. It's the second time in 2 days that you've brought that up.
All right, I won't bring it up again.
Yeah, I mean, come on. All right. So, but as you think about the next week, and of course, next Wednesday, we're going to hear from Jay Powell once again. And I'm just wondering, because I've been thinking about this over the last day or so, and I'm sure you have as well. Do you think the Fed's job got easier given the latest run of data on explaining to markets their thinking? And also, as a reminder, we're going to get a new dot plot. So is there any reason for that to change? And just, do you think the work here that so many Fed officials have put in on our air and others in emphasizing that they're going to, wait through this transitory period, do you think that job got easier?
Well, you pointed out with the bond market sell-off in the winter, it really actually extended effectively until March. That was when we saw some of the highs on the 10-year and the 30-year on those longer-term bond yields. Now, that was the big test of how markets were kind of digesting the Federal Reserve's new reaction function, which, by the way, was set out in that new framework in August of last year. But it wasn't until the reopening of the economy where it was really starting to be tested. How resilient would the Federal Reserve really be as we started to see higher inflation readings? And I think, as you mentioned, about now is when markets have kind of settled in a place where they kind of understand that the Federal Reserve is going to be patient. Now, I think the problem, though, is that, yes, right now it might be easier for the Fed to say communicate what it's trying to do here ahead of next Wednesday's FOMC, but we could be set up for a very interesting next, let's call it 3 to 6 months in terms of possibly higher inflation readings, at which point there could be some level, as the likes of Chris Rupke have said, where inflation readings might get the markets to flinch again. And I think if we started to see even higher prints from here, because you look at headwinds like, for example, housing, the way that the CPI kind of digests housing prices suggests that actually, we haven't seen the full impact of rising home prices in the CPI print that we even got yesterday, which implies we could get even higher readings in June, July CPI prints. So I think that could be a further test of the Fed even beyond the next FOMC meeting, which could set up a very, very interesting discussion if the Fed does indeed start talking about tapering in the next meeting.
We're talking about tapering. I guess they've begun to talk about tapering at this point. Brian, thank you. And I should mention as well what I was saying about foreign buying. There's a story in the Wall Street Journal this morning about how the low dollar has been bringing in foreign buyers to treasuries. Remember, if you buy treasuries, the price goes up, the yield goes down. So that could be something else that's putting at least a limit on what we're seeing in the treasury yields.